Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back. We're going to recap all of the trades that we made here on Tuesday, July 22nd. Had a pretty quiet Friday and Monday, made no trades. Not that we didn't have orders working, but just nothing actually got filled. Tried to make a couple of earnings trades on a couple things, but really just didn't get the prices that we wanted. And finally had a lot more activity here on Tuesday. So we had 2 opening orders and 2 closing orders for August expiration. After we go through these alerts, I just want to kind of cover where we are with our portfolio and then also talk a little bit about earnings. So watch the whole video. Obviously, we're going to go through the trades here first so we get these out of the way and talk about those. But I definitely want to talk about just kind of strategically what I'm looking at right now as far as positions and where the portfolio is. And then also start talking just a little bit about what you can expect around earnings. There's still a ton of companies that have to report earnings. So we're not out of the woods yet. And this still means that we have some trades that we can make as far as earnings and some strangles or straddles, whatever the case is. So let's actually start off the night with the strangle and Microsoft. And now this is an earnings trade as I sent out in the alert. And I know this went out late in the afternoon, but we actually got filled on this thing, I think about 3:56 in the afternoon, so a couple minutes before the close. And we got it out just as soon as possible. I know some people got into it, some people didn't. It was just a product of whatever the market gave us, filled us right at the end of the day. Had this order working pretty much since 1 o'clock in the afternoon on Eastern time, so it really didn't even fill until just before the end of the close. But what we did with Microsoft is just did a very basic strangle on Microsoft, so where we sold naked both a call and a put. Now we decided to go with the weeklies, and I'll actually go through that here in a second when we look at the trade tab. But our whole strategy with Microsoft and with most of the stocks that we trade around earnings is we want to take advantage of the drop in implied volatility, right? The stocks have this run up of implied volatility heading into earnings, and we want to take advantage of that by selling premium or selling options. And then right after this earnings event, we have a 1-day time where implied volatility should drop like a rock, and that gives us an opportunity to profit. Very similar to what we've done before in the past in Home Depot and Lowe's and so many others, and just recently in SanDisk. Now, with this weekly strangle in Microsoft, we did decide to go closer with the weeklies, so the weekly July 4 contracts. The 30 or the 47 on this alert is tied in with the call right here. So we sold the 47 call, and then the 43 is tied in with the put option. So we sold each of those, and total we took in a credit of 55 cents. Okay, so it's just a very small trade, a 1 lot, just trying to play things conservative. Microsoft didn't have the best premium, but it was good enough for the expected move that Microsoft was going to make. So by selling it at 55 cents, that moves our break even down to 46.50. I'm sorry, it moves our break even up to 47.50 on the top side and moves it down to 42.50 or so on the bottom side by selling that for a $55 credit. Now, if we actually just take a look strategically at the chart here with Microsoft, we obviously had a pretty big move heading into earnings, right? So it had a huge jump in its price just in the last 2 weeks heading into earnings. Now, my thought process on this is a little bit different than some people. You could look at it 2 ways, so I'll explain both. One, you could say, okay, it's got a great move into earnings, meaning that somebody may have, possibly, kind of expected, or there's an analyst out there that expects some sort of really good news that might have swayed the decision in earnings just recently. Other people look at this and say, you know what, I'm going to buy the rumor and sell the news. So they buy this rumor of great earnings, but when earnings actually come, they actually sell this thing off right afterwards. Now, either way, we're just in this thing for basically a 1 to 2 day trade. So we don't care long term where Microsoft is going, nor do we care about any other stock where they're going long term. But that's just kind of the setup we have. All of that disregarded, we have an IV percentile of 73%. So Microsoft is absolutely at the top end of its implied volatility range and likely should be because of this huge move that we had here. So that gave us a great opportunity to sell a strangle and go on either side of the market. So we had the 43 here, so we gave ourselves room here, and then the 47, which is just above where the chart is on your video here, and gave ourselves room on the top side. Very even in how we're doing this, so we're about $2 wide on either side, and expecting Microsoft to stay inside of that range tomorrow when it opens, so we have an opportunity to profit. Now, after the market closed, Microsoft released earnings, and right now is trading at 45.50 or so. So that's currently where the bid ask is trading. So it's trading just a little bit higher by about 50 cents or so from where it or 70 cents or so from where it closed. So that's okay. It's not too far off of where we thought it was going to be. It's going to have some movement, which is good. So long as it stays below 47.5, we should be okay in where we're trading. Now, if we actually take a look at the actual trade tab of Microsoft, you'll notice first that we chose the weeklies over August. Now, the reason that we did this is because you'll see here these August expiration options have implied volatility that's right around 28% for those individual options. Now, this is not the IV percentile. That's different, and we have video tutorials about that if you're just new with us and getting started. That's not the IV percentile. It's the actual implied volatility of those options. But you'll look above and you'll see that the implied volatility of the July options for the weeklies, which only have 3 days left because they're right in the middle of earnings, have 55% implied volatility. So they have a little bit more volatility baked in because of the earnings event coming up on the calendar. Now here's where our position is laid out for Microsoft so you guys can see it. Again, we did the 47 call on the top side. That particular option has about a 78% chance of hitting, or 78% chance of success. So almost 80% chance of success on the top side. And then on the bottom side, our 43 put has about a very similar chance of success, around 80% or so. So you can see that really what we're trying to do in this trade was target about the 80% probability level on either end. So 80% on the top side, 80% on the bottom side. That gives us a very wide range that Microsoft can move in. We're not trying to make $1 million here. It's just $55, but staying active in the trade. Okay, so you could have obviously scaled up. I would have liked this spread to trade somewhere around 75 cents to $1 for Microsoft earnings, and just given its past, I thought that it was going to have a pretty big move, and it doesn't look like it's going to be that big of a move, at least right now. All right, so the other opening trade that we had here today was Netflix. So Netflix actually had already released earnings and had traded down on some pretty heavy volume in trading. So what we're trying to do here is take advantage of this move lower and just assume, you know what, Netflix might continue lower based on its recent past. We went all the way out to September for this debit spread because we want to give ourselves much more time to be right in this trade. It's a very simple debit spread. We're not trying to take advantage of some implied volatility move. It's the 430, 425 put debit spread, and we paid a little over mid price at 257. Now what's great about this trade for Netflix is that since we paid a little over mid price and our break-even price is around 247, that means that we're actually buying this spread. Oh, I'm sorry, where's Netflix? Oh, I'm sorry. NFLX. So our price is around 427. Sorry, I said 227. So our break-even price is around 427. We had a little bit of a move up in the stock here today from the lows of the day, but our break-even price around 427, that's pretty good for us. We're actually pretty comfortable with that. We're taking definitely the bearish stance, so we're a little bit in the negative here with this one, but you can see that after earnings have already come and gone, implied volatility is absolutely much lower for Netflix. So we're not going to try to take advantage of any implied volatility move. Rather, we're just going to take advantage of possibly a move lower in Netflix over the next month and a half. We've given ourselves all the way to September to be right. And you can see just based on the history of Netflix that it's a very quick mover. It can move down very, very fast, which means that we may have an opportunity to take a profit here in the next couple days as people start to react to this earnings event for Netflix and the guidance. All right, so two of the trades that we took off today are Yahoo and HPQ. HPQ was a debit call spread that we had originally entered. It was the August 33-35 debit call spread. So we originally bought the 33 strike calls, sold the 35 strike calls. We paid a debit of around 112 for that. And then today we were able to sell that whole spread back to the market or reverse that trade. So we got out of the 33s, or we sold those back, and we bought back the 35s to close out the trade. We paid or got a credit of $145 on each of those options, so made $33 in profit for each. Now, the reason that we got out of this trade a little bit early, even though we had all the way until August, is because HPQ made a huge move higher, right? This is a directional bet where we were basically at the market making a 50-50 bet right around where the market was trading, which was about 34 at the time. So HPQ has made a huge move higher. So it's made the directional move that we want. And the most we can make on this trade is $2. So we've made a pretty good chunk of our money just in the last week or so of trading this. So for us, it's really about a matter of keeping on that additional risk for really no additional benefit, right? We've made a pretty good chunk of money here real quick as the stock has moved up from 34. It's moved up all the way to 35.15. So both of these options are in the money when we got rid of these today, which is really good. And we definitely want to keep that opportunity of making that money by just closing out the trade altogether and moving on to the next one. All right, and then the last one that we closed out of here today is Yahoo. So Yahoo is one of those trades that we had hedged into an iron condor. So we originally did not have an iron condor in Yahoo. We had sold a put spread and then sold a call spread against Yahoo, and together that put spread and that call spread made up this iron condor in Yahoo after earnings. Now we originally did that after earnings with Yahoo because Yahoo had traded lower after earnings and was starting to test our lower boundary put spread, which was the 33.31 put. And if you go back to that video tutorial where we enter that hedge in Yahoo, what I had said is that we're doing the 36.38 call spread, which is the same width in strikes. So you see it's a $2 wide strike versus a $2 wide strike. And we sold the same number of put spreads that we sold, and we matched that up with the same number of call spreads. By doing this, we incurred no additional margin or risk. So we had no additional risk. It was not that we were going to lose any money. All we did was increase our potential for profit and also reduce risk or reduce our possible loss. Well, in this case, Yahoo kind of rebounded a little bit, which is exactly what we wanted to happen. Implied volatility has continued to shrink as earnings have come and gone for Yahoo. So today we were able to buy back this entire spread for 65 cents, basically capturing a $33 profit, which really was helped by this call spread that was way above the market at 36.38. So that hedge really drove a lot of these profits and is a great example of using a hedge to help increase the chance of success on this trade. Without this hedge, we'd still be looking at a very, very small winner right now, not as big of a winner as we actually had for the position size. So really, really excited about that Yahoo trade. You can see here on the chart with Yahoo that right after earnings, it originally challenged our 33 put spread below the market, so it had that huge drop, and all we did was go in here and sell the 36.38, so that gave us a line in the sand or a break-even zone right here around 36 and above where that strike was. But now that we've started to see a little bit of a move higher in the stock, and it didn't take much at all, little bit of a move higher in the stock, as well as implied volatility dropping for Yahoo down to, if that thing would go away, down to around 20%, or the 20th percentile, that really helped kind of solidify this iron condor as a trade that started to make money. So just in the last couple of days, started to make some real good money with this trade. So at this point, we're still about 60 cents off from our first strike, so we want to go ahead and close out this trade for a profit and move on. All right, so now that we've kind of talked over all of these different trades here today, I just wanted to kind of show you guys where I'm at right now with my portfolio as far as trades are concerned. I allocate a lot of this stuff here, that's all closed trades. I allocate a lot of this stuff here on the video and in my portfolio, as many coaching students know, based on these categories of trades. So what you'll see here, and I've shown this a number of times, is I have categories for things like butterflies, calendars, call credit spreads, call debit spreads, call put spreads, etc. Now what you'll see generally is that my portfolio is a little bit bearish in the way that it's tilted, right? I've got some calendar spreads that are below the market. I've got FCX butterfly, which is a little bit negative as far as we're concerned. And then I've got basically call credit spreads, which are positions above the market wanting the market to go down, and put debit spreads. So I have positions where I definitely want the market to go down. I'm buying put debit spreads, wanting the market to go down. So generally speaking, I'm a little bit bearish in my tilting. Not exactly what I would necessarily want. I don't want to be too bearish, and you can see that right now my delta, or my beta weighting for deltas on my portfolio right now, hopefully you can see this on the video, is about negative 1.26. So much, much more bearish than I actually want to be heading into earnings. Not that I'm bearish in the market or want to be bullish, whatever the case is, but I'm definitely going to be seeking out actively some call debit spreads to start getting some of those trades, and some put credit spreads if we can find some around earnings to start getting into some of those trades. Okay, so that's exactly what I want to start going after, just as a way to help balance your portfolio, right? So you want to definitely be not only diversified in direction, but also in strategy. I don't want to always be trading credit spreads to the call side, or calendars, or butterflies, or whatever the case is. I want to be a little bit non-directional in the market, but also balanced and diversified in the strategies that I'm trading. And I talk a lot about that in the coaching program for those of you who have signed up and obviously are interested in that. And then as far as earnings are concerned, I just want to point out a couple of big names. Apple obviously had earnings after the close. doesn't look like we're going to see a huge move in Apple after earnings, which is really different than things like Chipotle. And again, I guess what I'm trying to point out here is we have absolutely no clue where a stock is going to go after earnings. People can be bullish, they can be bearish, they can think that there's going to be a huge pop or not a huge pop or whatever the case is. But when it comes down to it, we have absolutely no idea where earnings are going to go. Take a look at Apple right here. It closed at 94.72 after the market has closed and after it's already released earnings. It's trading about 50 cents lower. I never thought I would definitely see that in Apple. And who knows where it opens up tomorrow, but it's obviously trading after hours in some pretty heavy volume and didn't make a huge move. We contrast this with something like Chipotle that had a monstrous move today and moved way outside of the expected move. Nobody saw this coming. It made a pretty dramatic move of about $70 in one day and has been known to have pretty big earnings moves in general. One that we got caught in a little bit back on April of this year. So Chipotle is definitely one of those ones that's moved outside of the boundary, and it was one of those high flyers that actually caught a lot of people down. We, fortunately enough, did not make a trade in Chipotle yesterday. Orders that we had placed actually didn't get filled, and I just decided not to make a trade in that and let those orders get canceled at the end of the day. So that actually really helped out because I'm glad that we didn't get caught with that run right now, and I guess the luck of the draw is in our favor right now. So that's generally where we're at with earnings, and just want to kind of go over those in the portfolio. Hopefully that helps out. As always, if you have any comments or questions about the trades that we made today or anything else for that matter, please add them right below this video. I'll be sure to get back to all of those tonight or tomorrow before the open, and happy trading.